Welcome to the Deep Dive. Today, we're turning our attention to a really big player in California's energy scene, Edison International. Ticker EIX.
That's right, a major utility.
So we've got this recent, pretty detailed stock analysis on EIX. And our goal here really is to cut through all the noise, pull out the key stuff, and give you a clear view of the company.
Yeah, what's its current state, the financials, risks, future plans, all of that.
Exactly. Think of it like a shortcut to getting up to speed on EIX. It's right there at the center of California's whole clean energy push, isn't it?
Absolutely. A critical company in that transition.
Okay, so let's dig in. What does this analysis tell us about where EIX is standing right now?
Well, looking at the snapshot the analysis gives us, Edison International is currently trading around $56.64 share.
Good.
That puts its market cap at roughly $22.2 billion.
And what really jumps out, I think, especially if you're looking at income stocks, is that dividend yield. It's sitting at 4.2%. Solid.
It is pretty solid. And the PE ratio is, well, quite low, too, about 8.15.
Right. So for value investors, those numbers might look, pretty tempting on the surface.
They might. But the analysis pretty quickly gets to a really crucial point. The stock's actually down significantly, about 25% over the past year.
Wow, 25%. That's substantial. And what's the main reason the analysis gives for that big drop?
It's quite clear on this. The major factor weighing on the stock is the ongoing risk related to wildfires in California.
Ah, yeah. That's the big shadow hanging over utilities out there, isn't it?
Yeah.
And the analysis mentioned some pretty recent news on this front, too.
Exactly. It points to the recent settlement with the U.S. Forest Service. This was about the 2020 Bobcat fire.
Right, I remember that one. Huge fire.
Yeah, burned over 180 square miles. The settlement was for $82.5 million. Southern California Edison, that's the EIX subsidiary, was accused of negligence in the analysis source.
But, and this seems important, the analysis also notes Edison didn't actually admit any wrongdoing in that settlement.
That's correct. No admission of fault. The way the analysis frames it is, well, it's a move to help recover costs for the Forest Service, sure, but maybe more importantly for EIX, it reduces some of that legal uncertainty around that specific fire, sort of clearing the decks a bit.
Okay, so we've got this stock price that's clearly feeling the heat from ongoing wildfire risk, even though there's been a settlement on one past fire. How are the actual financials looking in the middle of all this?
Yeah.
The analysis mentioned a positive turn recently.
It did, yeah. If you look at the Q1 2025 results, the net income showed a really strong positive swing. Came in at $1.44 billion. That's compared to a loss in the same quarter last year.
That's a pretty big turnaround from red to black.
Absolutely.
Yeah.
And the core EPS earnings per share, a key profitability metric was $1.37 for Q1. The analysis notes that puts them right on track for their full-year guidance.
Which is what, around $6?
Yeah, the range is $5.94 to $6.34. Now, total revenue did dip slightly quarter over quarter, about 4.3%, but the report still describes their margins and operations as healthy.
And the full-year numbers for 2024, they showed some pretty big scale, right? Like $17.6 billion in revenue.
Yeah, $17.6 billion revenue, $2.5 billion in net income, and importantly, operating cash flow of $4.3 billion. Those are definitely substantial numbers.
Very strong operating cash flow.
Yeah.
But the analysis also flags something that might raise an eyebrow. Negative free cash flow for the full year.
Right. That's the one that might look a bit concerning at first glance.
So negative free cash flow. That means they spent more cash than they generated after covering their capital spending needs. Yeah. How does a big profitable company end up there, according to this analysis?
Well, the report explains this is actually pretty common for utilities right now, and it's tied directly to their strategy.
Ah, okay. So not necessarily a sign of weak operations.
No, not according to this source. It's mainly driven by incredibly high capital spending. Utilities like EIX are just pouring money into infrastructure right now. Upgrading the grid, wildfire hardening, building out capacity for clean energy.
All that stuff we hear about.
Exactly. So while that operating cash flow is strong, like we said, the sheer amount they need to invest means their free cash flow, after you subtract those huge CapEx costs, is negative for the time being. Frames it as funding the future, really not a sign of current weakness.
Okay, that's really important context. Spending driven by future needs, regulatory pressures. Makes sense.
Mm-hmm.
Now, speaking of value, the analysis tossed out a few different intrinsic value estimates, and they seem Well, kind of all over the map.
They really did vary quite a bit. The analysis listed figures from Yahoo Finance at $55.94, then valueinvesting.io at $66.41, MacroAxis way up at $85.56, and AlphaSpread even higher at $135.78. That's a huge range.
Yeah, why such a massive difference? How can estimates for the same company be that far apart?
Well, valuation models, especially things like discounted cash flow or DCF, are super sensitive to the assumptions you plug in.
Like future growth and risk.
Precisely. Future growth rates, the discount rate you use to value future cash, how you perceive the risks. Different analysts just use different assumptions based on their own outlook.
So how does this particular analysis make sense of that spread?
It gives its own context by saying that based on what it considers a, quote, reliable DCF analysis, the best fair value estimate is probably around that $66.41 mark.
Okay, the valueinvesting.io number.
Right. And based on that specific interpretation, it suggests EIX is, modestly undervalued right now, maybe about 17% upside from the current price. So models vary wildly, but this report kind of leans towards that $66 figure as being pretty credible.
That helps frame it. It's really about different perspectives on the future. Okay, let's shift gears slightly.
Sure.
Who actually owns EIX? The shareholding structure details in the analysis were quite interesting.
Yeah, they show that institutional investors hold a really big chunk, about 69% of the shares, and mutual funds alone hold around 67.5%.
Wow, so it's dominated by the big players. The analysis mentions State Street, Swiss National Bank, Sumitomo Trust.
Exactly. And then, in stark contrast, the amount held by promoters or insiders, basically the company founders or management, is tiny, only 0.2%.
So almost entirely owned by large institutions. What's the significance of that, according to the analysis?
Well, it interprets this high institutional ownership as a strong vote of confidence, from large, supposedly sophisticated investors.
And what does that usually signal for a company like EIX, a big utility?
For a regulated utility that needs huge long-term investments, high institutional ownership is often seen as a positive sign for stability.
Yeah.
These big funds tend to be long-term holders. They're less likely to panic and sell on short-term news compared to, say, smaller retail investors.
So it suggests they believe in the long-term plan.
Yeah, it suggests conviction in the company's long-range strategy and its stability, despite those immediate challenges like wildfires. The analysis also noted the ownership is mostly U.S.-based, about 62.5%.
Okay, so the big money seems to be betting on the long haul here, and that leads us right into the company's future strategy. What are the key plans and initiatives Edison is focusing on, according to this analysis?
The analysis lays out several major strategic pillars. First off, and this directly tackles that big risk we keep talking about, is a massive wildfire mitigation plan. We're talking an investment of roughly $6.2 billion.
$6.2 billion just on fire mitigation.
Yeah.
What does that actually involve? What are they spending it on?
Well, it includes major efforts like undergrounding power lines, burying them so they can't start fires, also deploying advanced AI for early fire detection, and putting in smart grid tech to manage power flows better and cut risks during high danger periods.
So a direct, very expensive response to their biggest headache.
Yeah.
What else is key for their future path?
A huge focus is the broader clean energy transition. They've got stated goals for net zero emissions by 2045. That means big investments, including building out the infrastructure needed for more electric vehicles.
Right, the EV charging network.
Exactly. And related to that is grid resilience, basically making their energy delivery system tougher, more climate-proof, using things like microgrids and battery storage to handle extreme weather or other disruptions better.
Okay, this all sounds like where that high capital spending, the CapEx driving negative free cash flow, is coming from.
Precisely. The analysis explicitly mentions planned CapEx of $25 billion to $30 billion over the next 5 years. That's huge. And the way a regulated utility like EIX funds this and justifies it to regulators is through their rate-based growth strategy.
Right. Can you quickly unpack what rate-based growth actually means for a utility?
Sure. So for a regulated utility, its profits are essentially tied to its rate base. Think of the rate base as the value of all its physical stuff: power lines, substations, power plants, the whole grid infrastructure.
The assets they use to deliver power.
Exactly. As they invest billions in new equipment or upgrades, the rate base gets bigger. Then, the regulators allow them to earn a specific rate of return, the ROE, return on equity, on that larger asset base.
So investing more lets them potentially earn more if regulators approve.
That's the basic idea. By spending that $25–30 billion, they grow the rate base, which should allow them to increase revenues and earnings down the line, assuming they get regulatory approval. The analysis mentions they're aiming for 6% to 8% annual rate base growth and have filed for an 11.75% ROE in their next big regulatory case.
And the analysis pulled a quote from their CEO, Pedro Pizarro, that seemed to wrap this all up nicely.
Yeah, it did. The quote was, "We're making the grid safer and smarter for a carbon-free future." That really ties together the wildfire safety work, the grid improvements, and those big clean energy goals.
Okay, so let's try to bring all these threads together. We've got the current stock situation, the big wildfire cloud, the financials, including that negative SCF explained by massive investment, the different valuation views, who owns the stock, this really ambitious future strategy. How does the analysis synthesize all that? What's the sort of takeaway for you looking at EIX?
Well, the analysis lays out the decision points pretty clearly, I think. It suggests you might lean towards buying if you're primarily seeking a stable dividend. That 4.2% yield is attractive, right?
Right.
Or if you really buy into the long-term story around clean energy growth and ESG factors and, environmental social governance. For EIX, that means all those investments in greening the grid and making it safer. It's also a fit if you just prefer regulated utilities, which tend to be less volatile than other market sectors.
Makes sense. And on the other side, who might want to hold off or even avoid EIX based on this report?
The analysis suggests maybe holding or avoiding if your main focus is short-term gains. Remember, the stock is down over the year and quick wins might not be obvious. Also, if you're really worried about those potential future wildfire liabilities, that risk hasn't gone away entirely despite the mitigation spending. Or, simply if you prefer chasing higher growth in areas like tech, rather than sticking with a slower growing regulated utility.
So it really paints a balanced picture, depending on what you're looking for as an investor and your comfort with risk. What was the ultimate bottom line from this specific analysis of EIX?
The final takeaway presented is that Edison International is basically characterized as a solid dividend stock. It's got some potential upside if you believe it's undervalued, and it's driven significantly by those long-term tailwinds, the clean energy shift, and the whole ESG focus. It's definitely a company navigating some serious immediate challenges while placing huge bets on the future shape of energy.
This deep dive really highlights the situation EIX is in. It's wrestling with these very real, very current threats like the wildfire risk, which demand enormous investment hitting their current cash flow. But at the same time,
they're pushing forward with this huge necessary pivot towards clean energy and a tougher grid.
yeah, it's a really compelling tension, isn't it, between the now and the future vision.
It really underscores the unique spot utilities are in today. I mean, they provide an absolutely essential service. They operate under complex regulations. They need constant, massive infrastructure spending. And now they're right at the forefront of dealing with climate change impacts and driving the energy transition. Evaluating them means juggling all those interconnected pieces.
Which kind of leaves us with a big question for you, the listener, to think about after all this. Given the truly massive scale of investment needed for California's clean energy ambitions and grid resilience, and considering those inherent risks like wildfires, how do companies like EIX actually manage these huge pressures, both financially and operationally? And what does that imply for where they're headed in the next few years? What part of this deep dive stands out most to you?
Yeah, definitely something to mull over.
Indeed. Well, thanks for joining us for this deep dive into Edison International. We really hope this gave you a clearer, more insightful picture of the company.